Assalamu alaikum, everyone. Welcome to fourth day of Ramadan. Our welcomes from Center for Islam and Global Affairs. We are in Istanbul, Turkey. Today, we are speaking with Professor Dr. Monzer Kahf. Dr. Kahf is currently Professor of Islamic Finance and Islamic Economics, Faculty of Management and Economics at Istanbul Sabahattin Zaim University here in Istanbul, Turkey. He taught at the Graduate Program of Islamic Finance at Hamad bin Khalifa University in Doha, Qatar, from 2008 to 2018, and the Graduate Program of Islamic Economics and Banking, School of Sharia, Yarmouk University, Jordan, from 2004 to 2005. He served as a senior research economist at the Islamic Research and Training Institute of the Islamic Development Bank in Jeddah, Saudi, 1995 to 1999. And he was a visiting professor at the Graduate Program of Islamic Finance, the International Center for Education of Islamic Finance, INCF, in Kuala Lumpur, Malaysia, in the summer of 2010. Dr. Monzer has 35 books, more than 80 published articles, and many conference and encyclopedia entries on Islamic finance and banking, awqaf, zakah, and other areas of Islamic economics. The doctor provides consultations and advice to Islamic banks and fatwa, both online and in the area of Islamic finance and economics. Finally, he was rewarded the Islamic Development Bank Prize for Islamic Economics in 2001 and the President of Syria Award for Best University Graduating Student in July of 1962. And my name is Dr. Obaid Ruff. I'll be moderating the session. I can say, having worked in Islamic finance for several years myself, it's humbling to meet somebody like Dr. Kahf, who's had a doctorate and has been practicing longer than I have been alive. Dr. Kahf is one of the pioneers in Islamic banking and finance. There are right now in the industry many people that hold themselves out as experts. They are not. These days, anybody can get online and say expert on a profile. They are not experts. There are very few experts in Islamic finance, and Istanbul Zaim University is lucky we have experts, and Dr. Kahf is certainly an expert. There's no question. With that, Dr. Kahf, the floor is yours. Let's learn about today's topic, which is reforming the finance sector. Definitely something timely in light of coronavirus. How do we reform the economy? We know that something is broken, so what can Islamic economics and finance offer the world?
Bismillahirrahmanirrahim. Alhamdulillahi Rabbil Alameen. Wassalatu wassalamu ala Sayyidina Muhammad wa ala alihi wa sahbihi ajma'in. Now, my topic is on reforming the finance sector. It is not on Islamic finance, as a matter of fact, but definitely it is inspired by Islamic finance. That's the nature of the issue, and in one word, if we really want real reform in the finance sector, we need to inspire that reform from Islamic finance. So after Bismillahir Rahmanir Rahim, we look at what is wrong in finance today. There is a lack of realism, a lot of lack of realism. There is a lack of balance. There is also a lack of moral screening of activities and transactions. So these are, prevailing now in the finance sector. And this came as a result of what we call, or what we came to call, the financialization, that is the turn of the capitalist system from being industrial capitalist and then service capitalist into becoming financial capitalism, pure, practically financial capitalism. Let's take a few, just few data, just to look at and try to see what is the effect, where are we now, in fact, in the effect of financialization. Take this on economic development, for instance. We notice that the finance contribution to the economy has doubled practically over the 50 years. It's not the last 50 years because the stat is a bit older. It goes up to 2000. So in the second half of the past century, the development, the growth of finance sector doubled, whereas the manufacturing sector declined by almost half, became half of what it used to be, from about 32% of the GDP to about 16 or 17% of the GDP, literally cut into half. Services have increased also, but that's another issue where services, we are turning again from services into finance service. The red line here shows the growth of a combined sector of finance, insurance, and real estate, because real estate is actually practically finance more than really construction. So take the second chart. The second chart tells us about the profit. The profit from the finance sector went from about 11% to about 45% over the past that period of 50 years, whereas profit from manufacturing have again declined from almost 50% into becoming almost only 10% of the profit realized in the economy. Other services remained about the same. They did not change much. So the increase of profit from finance. What is more interesting, again, is that the manufacturing companies themselves are collecting more profit from their finance activities than from their manufacturing activities themselves. So when we look at the chart that tells us about the earning, how is it transformed from being earning resulting from producing new goods and putting them in the market to financing the activities and the new goods. We notice here again the earning of the non-finance companies, essentially the manufacturing companies. Their earning from finance became about 50% of their total earning, so increased in a huge way. Again, if we look, the manufacturing companies during that period have started to earn from financial portfolios a lot more earning than they earn from their own activities. Like this, the car industry, for instance, they earn from the portfolio they hold in the finance market, which is a financial portfolio, all of it they earn from that portfolio a lot more than they earn from producing cars, and that applies to all other manufacturing activities. So if we take the components of this same manufacturing, the financial portfolio of the non-financial companies, we notice that about 60% of it comes from earned interest, then about 30% comes from more than 30% also from capital gain, the blue area, whereas we have less than 10% coming from dividends. Dividends symbolize the earning of those companies that we hold their shares. So the dividend really contribution, it symbolizes the production of these companies and their earning. That becomes the minor thing. Interest earning and capital gain make more than 90% of that. If we look at the picture, how it is very interesting in the around the year 2010, with a global total output of the whole world of about 63 trillion US dollars. In 2010, we have transactions in the equity market. Equity market means the share and bonds market. We have transactions in the equity market about 20% above the size, or rather 30% above the size of the total global production. If we look at the financial transactions that are done in the trading of derivatives, we find about 600 trillion transactions or assets actually held in the form of derivatives, which are all financial derivatives. Now, again, if we look at the transactions in foreign exchange currencies, they are about 15 times the total the whole world production. What do these figures tell us? A huge amount of resources are utilized and are made in the finance sector, and especially not only in the finance, all of it, but especially in part of the finance sector that is trading derivatives, financial derivatives, and trading equities, and transactions on trading currencies. Now, how many multiple these currencies that are being traded at the international market, how many double or how many multiple they make out of the export in the world is definitely, it goes in the 20 and 30 times, because the export in the world is only a partial of the total world production. So here the picture becomes really horrifying about the dominance of finance in our life today, and the dominance of the amounts of investments that the world put in the finance sector. And then if we look at a simple like experiment, assuming that we have the whole world or the whole economy or a society, a given society, assuming it consists of a number of people, definitely. And if we assume all of us lend each other, whatever endowment that we have at the beginning, and then throughout the year we make activities of lending, one lending the other, and then that other lending the next one, etc., etc., until we reach the last person in that economy or in that world, if you take it for the whole world, lending the first one where the lending started, lending it again, that same endowment. Each endowment is being lent at a given interest rate. Then each one of us will earn that interest rate, but who is going to produce that interest rate? Where would it come from if we do only finance activities, and who is going to produce food on the table? By exactly the same token, let's suppose and imagine the finance economy today. Say the finance economy is like we are in one room and we have a table on which we have 1,000 pound or 1,000 kilo of grain, and we have 100 brokers around the table, and behind these, each of these 100 brokers, there are hundreds of traders, hundreds of what we call, and it is only inside quotation because this is in fact a misnomer, what we call investors. They are not investors, and as we will notice in a moment, we have all these people behind them who give order, buy and sell, buy and sell, buy and sell, and the brokers start from the morning until the closing of the market at 4:30 in the afternoon. And what do we find? What is the result? The endowment that we start with in the morning, in all the total number of the investors, so-called investors, is still the same. But in fact, there a lot of changing hands took place. Some of them gained and some of them lost. But what is very interesting and very important to keep in our mind and to understand, that the quantity, the 1,000 kilo of grain that is on the table, that we traded throughout the whole day, and we made a lot of gains and a lot of losses for those investors, the same quantity is still the same. We have not increased the production of grain by all this shouting and by all the profits and the losses that were made during the day. We did not increase the quantity of grain by not even a single pound, or not by 1 grain. Now, if the finance sector and especially the derivative sector can really help and create real profit, let's then replace our farmers. Instead of giving the farmers tractors and seeds and inputs for their agriculture, let's give them computers, laptops, and have them click in the derivatives market, in the futures market, and see they will produce more than grain. And then what will happen to the grain production? There will be no more grain production. The world today lives under a type of what is called the reversed pyramid, or the upside down pyramid, where there are several layers of finance transactions, finance holdings, and finance assets that sit on top of the real economy, the small base of the real economy, whether real assets or real GDP, quantity of GDP. with the whole thing being in this way, the economy is not only less productive by withdrawing resources from the real investment that produces grain and industrial products, agricultural and industrial products, withdrawing resources from there and putting them in the finance sector. We are not only doing that, but by that, we are creating really fake profit. We are creating profit that are not in fact profit, rather they are transfer of wealth from the losers to the gainers. So the derivatives are, we know them, what they are. They are products that are that derive their assets from some other assets, some other instruments, some other underlining things, and they do not stand on their own. In 2018, the total amount of funds invested in the derivatives was estimated at $1,200 trillion. Of course, the estimate of the International Bank or the Bank of International Settlement is about 40% of that much, is 542 trillion. Yet, whatever estimate, we are talking about several doubles of the real economy. The total GDP of the world was estimated at about $80 trillion in the year 2018, 83 trillion US dollars. So with that huge difference, what are we doing? Where is our finance section is doing? Look at the trading in the future market, how it developed, say, over 30 or 35 years from 1970s into the beginning of the 2000 of the new millennium. So when we look at it, we notice that most trading in the future was to serve the sale of production of farmers, what the farmers expect as prices of their harvest. In the 1970s, we have most of the trade was in agricultural future products, and very little part was in precious metals. Now, how it went into growing into 2004, the financial instrument became dominant, occupying more than 70% of the future market. And the remaining, the agricultural products became very small portion of the market. So is the trading in currencies and trading in energy also. All these became very small relative to the finance instrument. Yet all the trading in the future market is a trading only in a virtual sense, not in a real sense anyway. Does not all the future trading, even when it is small in currency or in precious metals, yet it is a trading in the virtualities, not in the reality. So what will happen? Okay, to the above, the continuously growing indebtedness of governments and of corporations have grown over the past 30 years to a huge amount that makes it a real burden on the real economy. The high leverage of all companies and governments is getting out of control. The unprecedented size of investment in virtual assets. Virtual assets include not only Bitcoin and the other blockchain coins that are completely virtual, but also all transactions that are in fact not meant at all to reach the delivery level. Transactions that are meant purely for speculation, and transactions that are meant only to talk about how would it be in the future, the contracts, all the future markets. So all that becomes dominant over the real market, and we have the high level of speculation. That means contracts that are or transactions in contracts that are not meant to be executed. That is speculation. Contracts that are not meant to be executed. Transactions that are meant only to be reversed financially and not really be reaching any execution level. Now, the current crisis. It is true that the current crisis today that we are living and that we are threatened by the experts of the United Nations, that within even by the end of this year, 1920, food production in the world may not be sufficient to feed everybody. This crisis did not start in the finance. This is for the first time since the early 1900s that a crisis does not start, an economic crisis, very severe one, did not start in the finance. It started in the real market by the ability of not being able to go to work. It started by staying home, by locking down on everybody, creating a huge level of unemployment and creating a huge level of inability to work and produce. So this kind of crisis is an output crisis. How do we make up for that output crisis? How can we produce food through investments in derivatives and in virtual money and virtual contracts as we have them in the future market? Let's take a little look at what happened in the financialization. We created options. Options were not in the market some 40, 50 years ago. We created options. The objective was to hedge assets and liabilities. But with time, we thought that options create wealth. So we started trading options instead of using them only for hedging. What happened that in the crisis of 2008, options actually destroyed wealth. We created indices to understand the behavior of the market, but we started trading indices. What is trading indices? What does it do? It does not add anything at all to the production capacity of the country. We also created short sales. Again, we thought that they produce, they create wealth, and we started trading them. We created future markets, and then we thought the future contract create wealth, but we noticed that they actually destroyed wealth. We created contracts for the difference. CFDs, simply because we realized when we buy shares and when we buy a commodity contract, we do not intend to really own these shares. We only intend to speculate on price changes. So why not just make the contract only on these differences in the prices, on the price changes only? So we created contract for the difference, and we started trading contracts for the difference. But the final result that these contracts, along with other imaginary transactions that don't relate to the real market, they ended up destroying wealth. Excessive trading of currency. The trading of currency is necessary, but it is necessary to support the transfer of goods and services across borders. It is not necessary really to create, and it cannot create a profit from their own selves. So we thought that trading currencies create profit, and that profit was in fact profit for some and loss for some, for others, and the final thing is the amount of endowment is the same. No profit really is created. So we started also trading risk and packaging risk, thinking that risk creates profit. Risk does not create profit. It is assets and goods and real inputs that create real added wealth. Risk is associated with these and cannot be itself a creator of profit. So the final result is we fell in the trouble. We expanded debts, and we started trading debts, and we thought that trading debts create wealth. In fact, a debt is in its reality is an abstract asset that does not produce any increment, does not generate any increment at all. And the reality is that trading debts only transfer wealth from one person to another, but does not create added wealth. So debts and debt trading, like others, do not create wealth. They rather pull down even remote investment institutions, like what happened to Lehman Brothers. Lehman Brothers was not a bank that deals or that dealt with direct financing to corporations and individuals. It was a bank that dealt only with trading debts from other banks. It was a bank of bankers, and it was one of the first major institutions that fell down. What is the reform then that is needed in this kind of financial world? Reforms from inside have come, and there were attempts to reform. There were the liberalization of the 1980s was an attempt to reform the market. Coming back to regulations after 2010 and the resetting of the standards of the Wall Street by the laws that came were also attempt of reform. This reform, even after the reform, before 2008, in 2006, the options out of total derivatives were estimated at 600 trillion US dollars. Now they are estimated at 1,200 trillion US dollars. So what we did, in fact, was to really regulate the fake transactions. With these regulations, because they came from inside the box, they did not notice what was really wrong in the finance sector and what kind of reform we need. They came from inside the box, and the reforms from inside the box did not help. The most serious problem is a persistent and intensive misorientation, misunderstanding of the finance sector by confusing its support and service function with wealth creation function. The finance sector, based on interest, based on trading debts, based on trading fake transactions, fake contract, does not create wealth. The role of finance at the beginning, when finance started in the whole world, at the time of Adam, in the first economy, when we started helping each other, the role of finance was to help production and exchange. We assigned an incorrect role for the finance sector and the finance institutions. This diverts resources to wealth transfer instead of wealth creation. We were able to transfer wealth from the individuals to other individuals, but that did not help in creating new wealth. We went on, the finance sector went into a gambling type of approaches and activities of transactions. The financial reform that we need to go back to basics. What is the role of the finance sector? What should finance do in our economy? We need to redirect the finance sector to make it play a supportive role for the real economy, that is for the economy of production and exchange. Rediverting financial and human resources out of speculation and back into the wealth creating activities. We need a finance sector that helps rather than disturbs, distorts, or distracts our resources and our activities. We need a finance sector that facilitates channeling funds to the productive sectors and units in our economy, instead of attracting funds and other financial and human resources from the productive sector into speculation and into trading imaginary contracts. The financial reform we call for, yes, definitely regulation is important. Nancy Pelosi in 2010, when the reform, Obama reform of the finance sector was adopted, said that we are not going to allow the Wall Street to rule over the real street. But actually the reform did not fulfill that objective, did not take the control away from the Wall Street into the real street. So what is needed is, what do we regulate? Are we regulating the options and the futures and other fake transactions and fake currencies and fake contracts and speculative contracts and debt securitization and debt trading? What are we going to regulate? What is needed really is to go back to the basics and look at what is the reform that is necessary. We need to reform the rules of the game in finance. We need to come up to understand what is really the function of the finance sector and its institutions, and look at how can the finance sector perform that function in servicing the real production and the real exchange. The rules of the game that need to be inculcated in our system are the following. We earn only if you earn, or we earn only if we own an asset that creates wealth. Without owning an asset that creates real wealth, you are not entitled to owning. You are not entitled to earn a profit or earn a return. The return should be only generated by real assets and be a real addition to the wealth that is being created in the world. Rule number 2, no fake assets and no fake transactions. Transactions that we make should end up always to be real, to be implemented as real transactions. So those who buy wheat in the market are those who are going to use wheat in producing flours and bread and cereals and other wheat products. And those who don't produce these, they don't need to buy wheat. Why should they buy wheat on the regulated market? So no fake assets and no fake transactions. The rule number 3 is we need to morally screen our transactions as well as our assets. An asset must be of benefit to humanity, of benefit to environment, of benefit to the societies, of benefit to everybody, or to somebody at least, but not just a production of anything that may sometimes be harmful, like what we have in the new productions even of these fake cigarettes that were as harmful as the real new cigarettes. Then what is next? A change is going to happen, but it may happen through a devastating revolt, a devastating revolt by the poor and needy, by the hungry, against a system burdened with repetitive crises, or we make start for the necessary change. Do we need to make a start? I believe, yes, we need to make a start. We need to make gradual elimination of zero-sum and other speculative contracts. We need our decision makers to wise up. Wise up. Why do we need in the market CFDs? Why do we need in the market contracts for the difference that are only based on speculation on price change? So why do we need them? We can live without them. They do not add to the world. Why do we use resources in them, both human resources and capital resources? We need to eliminate internet currency forums. We lived without internet currency forums for a long life. So we need really to come back with that. What is the benefit that is added to the production of goods and services in the world, to the production of food and industrial products? What did the currency forums, internet currency forums added to the production? We need to remove all these platforms, withdraw their licenses. We need to eliminate, to stop trading indices, stop betting on currency prices, eliminate short sale and short trades, all of them, and the similar. We need to go in the market and cleanse our markets, our regulated markets, from these speculative tools with the world becoming closer to each other, we, like what happened in the spread of the coronavirus, we need really to spread a new spirit of eliminating the fake transactions and depend on the real transactions that are done across borders. The second step of reform, we need a gradual elimination of credit and insurance derivatives, and then followed by elimination of all derivatives in general. We need to stop option trading. Options should only be used for hedging. So only buy those, and that is not difficult at all. In fact, it can be done that a condition for buying or selling an option is to have a position that needs protection. And then if you buy or sell an option, you cannot trade it. You can only exercise it, or the option will die out. We need to disallow securitization of credit derivatives and credit insurance contracts. All these should be eliminated, and that can be done. We lived in a world without these securitizations and without these kind of derivatives, and we can live again that way. We need gradual elimination of speculative patterns of behavior, like day trading. What does day trading produce? It gets more profit in some hands and more losses in some other hands. But in the final analysis, in a world that the real transactors, those who really want to invest in companies and those who really want to get out of companies are there, and they can be in the market connecting to each other. We do not need day traders, and we do not need market makers. We should withdraw their licenses and kick them out of the regulated markets. We need to reduce the market accessibility itself. Why do we need 7/24, 7 days a week, 24 hours? We can transact commodities or currencies or shares from Tokyo market to back to Honolulu market and to the San Francisco and Los Angeles and Honolulu market and Sydney market. Why do we need to trade 24 hours and actually 7 days a week across the world? That we can do without. We need to reduce the accessibility of the market to only a few hours, to make it only for those who really want to sell and really need to buy. We need to expand, to enlarge, to lengthen the trading process. Why not the trading process takes 5 days and 10 days? If you sell something, you can get the price of it only after 5 days. And if you buy a thing, you cannot really reach its accessibility until after 5 days or 7 days. Why it should be a few seconds? And when you buy, you cannot sell quickly again. That can be done, and we need to make these reforms that it's not only a behavioral matter, it is a regulatory matters also. We need to genuinize organized markets. The markets of equity, the markets of currencies, and the market of commodities need to be genuinized, adding conditions to make transaction genuine. Like, for instance, eliminating leveraging, eliminating margins that make the transaction with full payment without margin. So make all transactions more genuine. Restrict commodity futures to hedging real market positions. Commodity futures may be useful, but they are useful only for hedging, not for trading. So we limit them to only hedging existing positions, whether producers farmers who produce commodities, or the users of these commodities, flour mills who use this grain, and they can trade them, and they can trade future. They can have futures transactions, but only with ending with real delivery. Restricting currency futures again to hedging only existing positions, and so on. So genuinizing our regulated market. We need to rechannel finance to become strictly through sale, lease, and venture capital. What does that mean? It means that there ought to be no finance for rescheduling debts, no finance for other than sale of commodities, sale of products. We finance the sale, we finance the consumers, we may also finance the suppliers, but we finance real transaction. Every finance transaction must be committed all the time to real finance transactions. That also applies to interbank transactions. Interbank transactions need not to be financial purely only. They can be genuinized, that interbank transactions again becomes related to the real market, not detached from the real market. We need to legalize interest on debts. Once debts are created through sale on credit is fine and beautiful. You create debt with it, but that debt remains with its creator, with the institution that brought it, that made it. It remains until it is dead. That makes the institution itself more prudent, because it knows you cannot throw the burden of this debt on any other person. You cannot throw it in the market. You cannot securitize it and throw it in the market. So debt creation is okay, but debt creation will end up by being ended and settled by the same institution that created it. It will be more prudent when it gives it and it collects it itself. And if it failed to collect it, then the same will be itself the loser if there is a default. So you be aware of that debt to yourself. Then there should be no interest on debt. Debts do not create added value. So if they don't create added value, there should be no effect coming out of debts when you transfer debt from a person to another, and don't transfer them then. The point number 6, we need to create a financial industry ombudsman. The supervisory authority failed over the last 100 years, as a matter of fact. If I use the statement of one of the governors of a central bank, he said that, well, the merchants have more information that we do, so merchants always succeed in playing the game on to their benefit with us. The same thing, the commercial bankers know the situation more than the central bank, and they have more information than the central bank, and therefore the commercial bankers can always play the game and in a sense of really cheating and benefiting and going around the regulations of the supervisory authority. We need a body in the market. We need a market body that goes on always to work as an ombudsman, that as a muhtasib, whose role is to detect the illness before it spread, before it grows, detect what is going on behind the walls, and not only what is going on the balance sheet. We need to look always what is behind the balance sheet, not only off the balance sheet, but also behind it. Okay, that we need also a standby public sector institution, public sector finance provider. If the commercial finance providers failed in providing finance to the real sector, that public sector finance provider may step in and provide finance. What happened in the remedies brought by the administration of George Bush II in beginning of 2009 was to help the wrong players. Instead of helping the wrong players, that helping the wrong players did not make the help reach on time to the producers in the market. And that what exaggerated the unemployment rate in 2009. So what happened there is instead with all these 780 billion US dollars, the George Bush administration could have created a finance public sector provider to help the direct producers of goods and services, and then to prevent the layoff of the 2 million workers in 2009. So we need a standby public sector finance provider that can step in at the time of need. What can central banks do in this regard? I believe that central banks are required to take action even from now, and even in each country. I live here in Istanbul, so here in Turkey, in Istanbul, the central bank is called on to take action to create suitable regulations to provide definitions of Islamic finance contract and put them all in correct perspectives in the market. The nature of Islamic finance is that it is done only through sale contracts or lease contracts or sharing contracts. So these need to be defined by the central bank and put in the market and be made available to all banking institutions, especially commercial banks. We need to reformulate and strengthen the Sharia governance in the Islamic financial institutions in a way that will take away and will take out these Sharia advisory boards that are paid for by the same institution and that provided cheap fatwa and cheap religious opinion. As at one time, Jamal Abdel Nasser said it, that a fatwa could be bought by a farkha, by a chicken, but now a fatwa is bought by the management of banks and Islamic banks and Islamic banks owned by conventional banks. A fatwa is given for money, and many cheap fatwas exist in the market. We need to issue regulations for sukuk and introduce suitable sovereign and corporate sukuk that are based on real development and not really based on recycling existing assets, selling them and buying them back from the stockholders. We need to tame out debt, pure debt transactions, whether in conventional banks or in Islamic banks. Tame out pure debt transactions by physically relating each finance transaction to the real goods and services. We need to eliminate pure cash transactions, whether from the Islamic banks or from the conventional banks. No debt circulation and no debt trade. We need to standardize profit distribution to investment accounts in Islamic banks, to depositors in conventional banks on a fair basis. We need to improve the corporate governance of all financial institutions, especially in Islamic banks, but also in all financial institutions, in all banks. We need to standardize accounting disclosures in the banking system, which is not fully standardized. And that is why we have a rundown on banks, because there is no disclosure of full information to depositors, whether in Islamic banks or in conventional banks. We need to also activate the role of the depositors to be participatory in real life, as depositors should be participatory in the profit and loss of the bank, not only be creditors of the bank. Other things, we need to standardize the processes of Islamic banks, whether we take processes, adopt the standards of a WOFI or of the IFSB, but we need to standardize them all. We need to provide adequate consumer protection. There is not enough consumer protection in Islamic banks and also in conventional banks. Not adequate protection of depositors and of other users of funds in both Islamic banks and conventional banks. We need to create inclusiveness and deepen the penetration of the banking institutions in the economy, the banking sector in the economy. We need also to create a robust market infrastructure for the internal capital market. Instead of the internal capital market being based on speculation, we should reformulate it to be based on real exchange of assets, real assets of the productive sector. We need to avoid virtual assets and virtual contracts, including derivatives, future options, etc. Tame out speculation in all markets, and they can be tamed. There are many ways to tame out these speculations, and we need to do that. We need other reforms also to level the ground in tax treatment, to allow fair competition between Islamic and conventional banks in the financial market. Level the tax treatment for instance, the sale that is used in Islamic finance is a financial sale, is not a sale that should be subject or can be subject to the value-added tax. It is a financial sale. We need to have plain and full competition, and definitely the Islamic finance will prove themselves then. We need to adopt a clear macro development policy and enhance credit allocation for development rather than credit allocation for speculation. We need to also enhance Sharia compliant interbank market. There are many tools that could be used for real life interbank transactions that should be enhanced without being based on either fake transactions like debt trade or fake transactions like tawarruq that are done by the Islamic banks. That brings my presentation to the end, and I'll be glad to receive your questions if you have. Thank you very much. And thank you for CIGA that gave this opportunity for me and for the Ramadan lectures, which is a very good idea. Really, thank you, CIGA, and thank you, Sami Al-Aryan.
Thank you, Dr. Kahf. Very interesting. This is a lot of information for individuals if they are not experienced in finance. I spent several years of my career as a corporate officer for a Fortune 500 financial services company. I can tell you that these recommendations are spot on. These are problems that in finance we know is happening. During the financial crisis, I saw properties that were worth less than $10,000, but banks were lending $500,000 against these properties. They were investing in the risk. They were hoping that gentrification would happen. They were hoping that the property would increase in value forever. They were investing in risk. They were not investing in the assets, and they lost. And this brought down the US economy in 2008 because they took that investing in risk, they securitized it, and they traded it, and then they traded it globally. One quick story I want to mention as Dr. Kahf recovers and drinks invisible water as it's Ramadan. We have another 3 hours before we can drink here. I've been online in meetings all day talking, and it's not easy to talk and not drink. When I started positioning in financial services, my manager made a comment that really bothered me. He said, if you take all the money in the world and distribute it equally, within 1 or 2 years, the money will end up right back to where it is now because of who's in charge, because of the market players. So many of these reforms that we're talking about, this goes, I think, to one of the most important questions submitted. Very good questions. I think this is one of the keys. How do we eliminate market makers? How do we kick them out when they are the ones that are controlling economics and politics? How do we reform the system when these people are in charge?
Well, definitely we have in any democracy, a democracy will fall apart if it remains in the hands of these few. So in any democracy, we need to create mechanisms that will bring change. And these mechanisms are in the hand of people. Elections may bring different people in the front. And it has happened in many countries. When it doesn't happen this way, then what will the result will be is what happened in Romania in the beginning of the 90s. So we either, this is the choice. It is our choice. We either do it with our own hands, with our own spreading the ideas, with adopting these ideas in the public, and then bring people who can make those changes. That happened, and it did happen in several countries. Actually, honestly speaking, I want to give the example, sorry to say it, but it is really a real example. The elections of 2001 in Turkey brought different stream of people. and they were able to make change, and they did make a big change. So these kind of changes can be done in any reasonable democracy. Definitely without democracy, no, you cannot. When you are dominated by the finance persons, when the election is determined by the dollar, then definitely you cannot bring a different breed of people. But when the election becomes determined and dominated by the human mind, then human people can do it.
Yeah, I agree. Doctor, do you think, following up on this question that this person asked, do you think these reforms would be easier if the US dollar was not the reserve currency in the world?
Yes, to a large extent, but yet the issue of being reserve currency, really, it's not an issue that America imposes. Yes, America did impose it at times with its abilities to dominate the market, but definitely the producers of major commodities in the world, and they can change that in the international market. It's not difficult at all in the international market to change the dominance of the US dollar. And yes, definitely, we need a change should be coming anyway, and we need that kind of change. That why should the dollar or the euro? I mean, we don't want to change the dollar to fall under another one, not the yuan or the euro or the yen or any other currency. Can't we make it through counter trade, through bilateral and through multilateral agreements, why there should be one settlement in the world? Let there be several ways of settlement in the international transactions, and it can be done. Yes, and so it is not really America that imposes it, in as much as, then if we quote Malik bin Nabi, we accepted it. We, as even smaller countries, can change it, can reject that and change it. Will take time, it will be slower, yes, but it can be changed through multilateral agreement between countries, and even through only bilateral agreements between countries on the basis of counter trade.
Yeah, another closely related question. The reform ideas that you mentioned today, are these better supported by a globally connected world? Is this supported by globalization, or is it more favored if we go back to financial activities by region?
Well, I mean, we definitely need both. We can't say that, okay, you cannot today, in today's world, you cannot eliminate option trading unless you connect the world together. It's not an issue of globalization, it's an issue of accessibility. The big difference, globalization meant big multinational corporations dominating the market. So they can do the transactions almost internally within the corporation, but with its different segments in different countries. That was globalization. Globalization is dying, and it's has already died practically. So what we need is accessibility, not really globalization in that sense. We need accessibility, and accessibility to each other should be made available through more open trade and open financial transfers between countries, but to be real financial transactions, not financial transactions that are based on speculating on currencies.
Closely related as well. The person asked, comment, forgive me to ask this question. I agree with more than half of your points to reform. Are your points for reformation? Would this create a world where laity could not make money from the financial world, and thus creating a world where lay people could only make income, can only make earning as employees from the financial world?
I didn't get, what do you mean by that?
So in terms of, you talked about it's okay to have hedging and options, but you need to have a market position. We should not be trading many of these synthetic financial documents. We know that most of the financial transactions in the world are bets on bets, and they're not directly related. If we eliminate the secondary market, if we don't allow trading and selling debt, is this going to make investments more difficult to the lay person, the non-investment banker?
Not really. I don't see it that way. Rather, I see it that if we limit financing to be through sale or leasing or sharing, we are allowing a great room for the venture capital and to finance small businesses. We need to remember that small businesses are the backbone of any economy, not only the American economy, but in fact, any economy is based on small business. So no, that does not render everybody employee. Rather, it encourages small businesses because it makes finance accessible to them instead of being only limited to the big corporations and in the big centers.
Yeah, I agree. Before I forget, later in the year, inshallah, sooner rather than later, many of the researchers and writers at CIGA will be writing blogs. I will have a blog. Dr. Kahf, I'm sure you'll be invited as well as contributor, guest contributor. If you're attending this webinar and you're interested in this topic, this is something that I will be blogging about weekly, about economic issues and how it affects politics and vice versa. And many other CIGA researchers will also be blogging about this issue and other issues. So visit CIGA's website frequently. Keep checking back until you see the blog posts available so that we can continue this conversation later. We have an interesting question here about currency. You mentioned fake currency. This individual wants to know, in the progress of human beings, didn't the use of paper currency instead of a barter, was this a good innovation as opposed to exchanging physical products, especially for a connected society across the globe? What do you mean by fake currency as opposed to currency as we have it today?
Well, I mean by fake currency, the currency that does not have a legal support that makes it binding to everybody. I am not against creating virtual currency or creating transactions with less use of currency as in smart contract. We can do that, yes, but this requires legal supports that protects everybody's interest. To have some of the people protected, but not all people protected, that is a virtual currency, not a real one. So I oppose the virtual currencies that exist today because they lack that legal support that protects the interest and the side of everybody, of everyone who deals with them. So this is the point, one point. But do we need to have physical currencies? No, we don't. Our currencies are already more in bank transactions and bank records than being really physical. The amount of physical is a small part of it, is paper currency. This paper currency was a good invention. We don't want to go to back to holding large quantities of gold and silver and say this is what this is our currency. No, not really. It could be anything. It could be virtual, but it has to be legally supported.
Yeah, interesting. Something that I learned when I was at Cambridge University about the history of currency. Currency was created to hurt people. It made taxation and paying fines and paying penalties easy. This is when currency really became popular. It wasn't to buy things, it was to pay taxes and to pay penalties and to pay fines. So if people listening to this want to dig into the history of currency, you would be surprised that the history is not very good for society. It's become good and it's enabled market trades to happen, but the history of currency was to hurt people and to tax them, stopping them at the bridge instead of taking everything on the wagon, taking their money. It's not a great history. What about short sales, Doctor? If we eliminate short sales, isn't short sales necessary mechanic to find price discovery in a free market?
Well, in a free market, we need real dealers. We don't want, we don't need speculators. And this is why we need also a world that is connected to each other. In the age we live in, the world is now connected and cannot go back to be disconnected, like we are connected now together from different places. So we need a world that is connected and at the same time it deals real. When it deals real, I'm not against a farmer having a contract on the internet with a flour mill. Yes, it's okay. And this contract is a future contract. So it will be delivered in June and it will be paid for also in June or July. That's not the issue. The issue is playing fake, making contracts that do not end with real delivery, making contracts that you don't belong to them, that simply because you are a speculator. This is what is needed. And in today's world, you don't need these market makers because there is enough number that is connected already together on the both sides of each transaction. Enough real number and real quantities that could be traded in reality without this market maker. Back in the 1970s, there was a need probably for market makers, that the people who absorb risk and stay in the market to buy and sell only, but they do not need to execute these contracts. They absorb risk. Well, that was back in the 70s at the time of Milton Friedman, but not in today's world. In today's world, there is a lot of real transactors that have accessibility to the other counterparties.
Yeah, exactly. You mentioned that the transactions happening, actual value is about $83 trillion. One number that you didn't mention that listeners might be interested in, global debt exceeds global GDP by over 300%. After coronavirus, I'm waiting for the new numbers. It's going to be scary. Before coronavirus, global debt exceeded global GDP by about 325%. That shows you how much of the economy today does not have actual value. It's just speculation. It's payments that banks are hoping to be made. They will not be made. People are already defaulting in major markets. A lot of this debt that's being traded will never be collected, and it's going to hit right now. Interesting question. A person asked regarding hedging. I thought Prophet Muhammad sallallahu alaihi wasallam was a mere trader, not a hedger, before his prophethood during his lifetime. Any Islamic precedent for hedging, Doctor?
Well, there was no Islamic president for riding cars either. Well, you don't need a president to see that a transaction is useful, but if hedging is done real, it's okay. But when it is done purely fake, it's not really hedging. It's trading these hedge tools. So trading the hedge tools is what makes it really awfully and unacceptable.
Let's look at the new questions that came in. Here's one interesting. Fahad asked, all the advices look perfect and show that it is well studied, even gives full path to solve contemporary economic problems. Then why at least the Muslim countries don't adopt, or is there any attempt or intention by anyone, especially Brunei, Malaysia, Pakistan?
Well, there are attempts of reform, but again, we need to spread the knowledge of what reform is needed. Unless that becomes real, really there, it's difficult really to say that this change is going to happen. No, Pakistan and Malaysia and Brunei and Turkey, they are trying to be on the right road, but they are still at the beginning of that. Now the rest of almost all the rest of the Muslim world lives under full dictatorship. So it becomes horrible.
Yes. Another couple more questions. A person asked, does Islamic financing schemes able to support the global business activities? It sounds like you're suggesting to go back to the gold standard. Definitely, yes, Islamic finance can support global schemes. London used Islamic finance to pay for its Olympic Village. Do you want to talk about Islamic finance schemes supporting global business?
Well, definitely it supports the global business, the real business, not the speculation. And the second thing, no, we don't call for going back to a gold standard or anything of that. We go back to be real, support the real market, the real transaction, the real cross-border trade, but of goods and services, but not really the fake one, the pure speculative one.
Exactly. One more question, Doctor. Do you have any recommendations for products to help farmers stabilize price instability if we eliminate futures and derivatives and some of the hedging products? What would you recommend to give farmers and manufacturers stability before they plant and start manufacturing?
Now, in a world that is easily connected to each other, we can have assured contract of sale of your farming products even before you plant the seeds. You look at the market, you can contract future delivery for your product. And that can be done, and it is easy to be done. And then deliver what you produce. You can add it to options that I can deliver 10% more or 10% less. With all these kind of additions in the contract can be done. And there is adequate number of counterparties on the two sides of each transactions, the farmers and the users of the farming product. Now, lately, by the way of this farming, you may have heard about destroying farming products in America instead of bringing them to the market.
Right. Yeah, it's insane. Absolutely insane. It's every time the global economy struggles in America in the North, and it affects the global South and poor people. It's ridiculous that they're destroying. It's a problem. Well, thank you, Doctor, for your time. I don't think we have time for any more questions. Please do visit CIGA's website and also Center for Islam and Global Affairs YouTube channel. We have all of the prior Ramadan lectures on our YouTube channel and also on our website, and all of the future Ramadan lectures will also be on CIGA YouTube channel and on the website. Tomorrow at the same time, our speaker is going to be Professor Dr. Jonathan Brown of Georgetown University, who will be speaking about what can the West learn from the life of Prophet Muhammad sallallahu alaihi wasallam. If you have not heard, thank you, Doctor, for your time.
Thank you very much, and thank you, Dr. Obaid, and thank also to CIGA.
And if our listeners have not had the opportunity to listen to Dr. Brown, I highly, highly encourage you to tune in tomorrow. He's extremely educated and funny. He's a fun professor to listen to. And we will have this lecture available online. There's a lot to look at and digest. I would recommend anybody in finance to print the presentation and really think about it slide by slide. There's a lot of information here. Thank you, everybody, for joining us. On behalf of CIGA, our director, Dr. Sami Al-Arian, have a good Ramadan, and ma'as salam. Assalamu alaikum wa rahmatullahi wa barakatuh.
Alaikum assalam.